Ladies and gentlemen, good day and welcome to PDS Multinational Fashions Limited Q2 FY22 earnings conference call hosted by Edelweiss Securities. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sandeep Agarwal from Edelweiss Securities. Thank you, and over to you, sir.
Yeah, hi. Good evening, everyone. Thank you. On behalf of Edelweiss, I would like to welcome you all to the Quarter 2 FY22 conference call for PDS Multinational Fashions Limited. From the management today, we have Mr. Sanjay Jain, Group CEO, Mr. Ashish Gupta, Group CFO, and Ms. Reena Joseph, Head Corporate Finance, M&A and Investor Relations. Without further ado, I would now like to hand over the call to Mr. Sanjay Jain for his opening remarks. Over to you, Sanjay. Thanks.
Thank you. Thank you, Sandeep. Hi, everyone. A very warm welcome to all of you to the second quarter and the first half FY22 earnings call of PDS Multinational Fashions Limited. In the first half of this fiscal year, we continued the strong growth trajectory and have surpassed the pre-COVID levels in terms of both top line and margin achievement. We have reported 35% growth in the first half of FY22, top line achieving 3821 crores versus 2822 crores in the same period of 6 months last year. We reported EBIT of 144 crore and a PAT growth of 6.2 times from 20 crore to 126 crore, largely driven by the top line growth, maintaining healthy margins, and a cut down in the losses of our manufacturing operations and route to profitability. This has translated into an expansion in our EPS to 40 rupees 52 paisa in the first half of this financial year as compared to the last year full EPS of 32.37 Indian rupees. The second quarter of FY22 has been our strongest quarterly performance in the last 5 years with a top line of 2195 crores. This quarter witnessed EBITDA growing by 138% from 35 crore last year quarter 2 to 84 crore, and this actually translated into a 3.1 time growth in PBT from 71 crores from 23 crores last year. With strong performance being delivered quarter on quarter, PDS is leveraging its robust platform to propel itself into the next growth phase. We are strategizing our way forward by unlocking potential in untapped geographies, untapped categories. We're building teams, we're collaborating with marquee customers, we're increasing the wallet share with existing customers, and also at the back end, very much strengthening our vendor network. We believe that we are well geared for further growth and profitability during this fiscal year. If I now go further into our various verticals, our sourcing business, which accounts for close to 96% of our top line, has clocked 32% growth in the first half of this year with a top line of 3662 crores. Further, this business reported an EBIT of 123 crore and a very healthy ROCE of 49%. As we had mentioned in the last earnings call, and in line with our strategy to expand beyond the predominant markets of UK and Europe, where we have been largely operating, we have deepened our presence in the North American markets in the first half. While we continue to strengthen and grow in our key markets, the two of UK and continental Europe, we are accelerating our presence in North America. And I'm very happy to report that what we have achieved in the first half of this financial year is almost equivalent to the sales in the entire year in the US market in the last full year. We are close to about 15% of our current top line is coming in from US as a market, and it used to be 9% about 2 years back. And we believe we are well on track for the North American market to cross the target 20% share that we had foreseen as part of our overall top line. As mentioned previously, in the last quarter, we have onboarded new business heads like Eric Ledal, Gaurav Pandey, and Russell White, who come in from strong industry background, providing us access to new geographies, helping us introduce new categories. And now we are very happy to welcome UK-based Charlie Raj to our platform. Charlie Raj, along with his team, will focus on lifestyle tech products, consumer products, and accessories. He's been a founder and leader in consumer products for the last 19 years. With this association, PDS gets an opportunity to further add to its product offering with its existing customers and develop relationships with new customers. However, we are excited about the potential that these brings on board. There is also a gestation period. While on one hand, we are very positive that as these new business heads, new vertical heads who bring in access to geographies, customer categories, would help propel the growth journey, propel the profitability. There is a gestation period that is always there to these verticals bringing the optimum performance. And therefore, the first 6-month performance that we have reported had an impact of 14 crore of the expenses or the loss that has gone into these new businesses. I would rather term this as an investment that we are making into pursuing newer path of growth and profitability. But for a stringent accounting principles perspective, what we have reported to you as a sourcing vertical performance and overall PDS P&L is after expensing of the 14 crore that has gone into investment into new verticals as part of the gestation phase. Further, in the last quarter, our organic award-winning British kids wear brand Lillian Fit was launched in India through an exclusive tie with Reliance Retail's fashion marketplace Ajio.com in an outright model. PDS has recently launched another brand, Turtle Dove London, from its global portfolio in India. This launch is happening through a digital-first format in association with firstcry.com, as well as it's also happening on its own platform, turtledovelondon.co.in. Turtle Dove London was reportedly created stylish unisex clothing for children, is housed in over 400 stores worldwide. So therefore, we continue to also follow carefully a path of introducing newer brands. And as I said, they're largely on outright model basis so that we are carefully launching them with keeping an eye on the balance sheet. PDS continues to broaden its reach to major markets by strengthening the vendor network in strategic locations such as Vietnam, which provides integrated solutions, and Turkey that benefit from shorter lead times. So friends, so far I covered with you the initiatives that we are taking in our top line ahead with engagement with our existing customers, newer geographies, newer categories, newer brands. At the same time, PDS is also putting equal efforts at the back end, wherein while Bangladesh continues to be our key sourcing location, we are paying equal emphasis to Turkey, which today contributes about 6% of our global sourcing. We have an active network in place with 60 plus factories, and we are laying a lot of emphasis so that it continue to cater very efficiently to our shorter lead time requirements. Vietnam at present is about 2% of our global sourcing. We have got on board a senior industry professional who would now help us actively source from Vietnam as a market as well. So as PDS is positive about continuing the accelerated part of growth, it is also, keep strengthening its partnership with its vendor factories. Likewise, in Sri Lanka, PDS through its subsidiary in Sri Lanka, Nolanka, has entered into strategic exclusive partnership with 2 manufacturing facilities for the production of baby and knitwear, creating to markets in North America and Europe. So that was about our sourcing vertical in terms of front end and the back end partnership with our factory location. Now coming to the next in our manufacturing segment, we continue to see strong top line growth of 84%, clocking in 225 crore in the first half of FY22, which is primarily driven through near full capacity utilization. And I'm very pleased to inform to you that our factories are full in this current quarter as well, and will continue to be full for the fourth quarter as well. So we should now, keep running our factories at near 100% capacity utilization. This has resulted in operating losses declining by 70% as compared to the same period last year. And our efforts on collaboration and increasing operational efficiencies are enabling us to reach a near-term target of achieving profitability. As I said, our factories are fully booked, and we also at the same time strengthening a management team to kind of hasten a path to profitability. As of now, friends, we are on track. The factory is full, with 70% reduction in the loss in the first 6 months to gradually inch towards a PBT positive in our 2 factories. With regard to our third vertical, venture tech investment portfolio, during this quarter, we have invested in 2 interesting and dynamic opportunities as part of venture tech portfolio. And then before I go deeper into it, I want to emphasize here that while PDS actively operates through its sourcing verticals, through its partnership with vendors, through its factories, we are very responsibly conducting ourselves in the ecosystem wherein we operate, that how can we contribute, to the sustainability agenda that got to be pursued by a company like ours. And therefore, in that direction, we made some 2 small investments in the last quarter. The first one being Philcore UK-based entity that developed a patented collection and processing method, through product destruction processes, allowing high-end fashion houses to transform waste and surplus stocks into granules. And these granules can then be 100% upcycled into brick slips, into shop fittings, and other artistic and functional objects. So this is our effort from a linear to circular economy, and we have acquired a 50% stake in Philcore. This allows the PDS platform to offer complete sustainability and end-of-life solution from take-back to resell to upcycle for all fashion product. The second is a Loop Digital Wardrobe, in which we have picked up 34% stake. Loop Digital Wardrobe is a sustainability and marketing solution that empowers the newest technology to have a positive impact on the environment and business performance. PDS is consciously working towards circularity, as I said, and we are glad to announce that PDS is now a member of the Sustainability Apparel Coalition, a global multi-stakeholder non-profit alliance for the fashion industry. So we will keep carefully pursuing this agenda, and I'm very pleased to inform you that close to 6 months back, we have acquired 50% stake in Yellow Octopus, a company engaged in the circularity agenda. And after we did this, acquisition, one of our key customers, Primark, has also chosen Yellow Octopus as a partner to pursue their, circularity agenda. And True, which is one of our partners in the venture tech investments, whose investment expertise we use to channelize our investments into our sustainability and digital brand agenda. Marks and Spencer has tied up with True to take further their circularity and compliance agenda ahead. So therefore, 2 of our one investee company and 1 partner that we have been associated with in channelizing our venture tech investments, they've also been acknowledged by 2 of our prominent customers. Moving ahead, we've been allow me to now come to some of the financials related to the balance sheet and capital employed. We continue to operate ourselves in a relatively asset-light balance sheet and a stringent risk management mechanism. We've been able to operate at comfortable gearing ratios with net debt to equity of 0.31 and net debt to EBITDA of 0.8 with insignificant long-term debt. Our long-term debt to EBITDA is close to 0.01, almost insignificant. And whatever short-term debt we have is in a way self-amortizing through the realization of the receivables. We've been able to demonstrate strong discipline, despite a North American operation witnessing high growth in H1, which operates on a relatively longer working capital cycle as compared to our business in other regions. So we continue to give utmost importance to our return metrics, and the increase in top line, increase in the profitability, and the also reduction in losses of our manufacturing operation have enabled a higher operating margins and resulted in 30% return on capital employed in the first half and return on equity of 34%. And lastly, as part of our journey to further strengthen our governance framework and also benefit from the presence of global and experienced professionals, we are pleased to have Mr. Mango Park, who has been, very actively associated with sustainability and related technologies agenda, who was earlier, as the global lead of Nomura Investment Banking, has joined our board of directors. We also have Mr. Robert Sinclair, who's based in Singapore, who's been in the industry that we operate in for close to about 25, 30 years. He's also come on board and bring an extensive industry experience and extensive network across the space that we operate. And both these gentlemen bring in decades of global experience enriching the PDS platform. We're also pleased to inform you that Mr. Tarun Khanna, who is a senior professor at Harvard Business School, has also joined the PDS advisory board. So as management team, we continue to seek the guidance of our strong board of directors as well. So we have grown from strength to strength and try to demonstrate the resilience of PDS platform even during the most challenging times in the human history. And we are getting ourselves for the next phase of growth driven by our long-standing relationship with the customer, our integrated network of vendors, and most importantly, our human capital, which truly makes our foundation stronger. And with this, I'll be very happy to answer any questions that you all may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are in handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Chirag Lodaya from ValueQuest. Please go ahead.
Yeah, thank you for the opportunity. Sir, my first question was on sourcing business. So if you can just help us understand what is our edge or say USP in this business, and why large retailer choose us, and if at the same time if you can also throw about who are our competitors, etc., that will be helpful.
Sure. I think our USP is around a few key points. Number one is proximity to the customer. So we have 50 offices across close to 23 locations across the world. We have a team of designers, 150 plus designers, who sit, for example, in London, very close to a location of the key customers. So that's proximity, is very important. And also we have, as I said, strong team of designers. Our usage of technology is able to impart an experience of designing, sampling, to the customer, and therefore come to an efficient and faster decision. We have a global supply chain arrangement in place that gives a full visibility to our customers, so therefore they feel very confident. And our ability to source from various parts of the world. So as I said, we have our own 2 factories in Bangladesh, our own 2 exclusive partnerships in Sri Lanka, but we also have many more partnership factories in Bangladesh, Sri Lanka, Vietnam, China, and India as well. We have partnership, and of course the important partnership in Turkey to cater to the fast fashion needs. So therefore, the ability to source through a vast global network, the ability to source through various kind of requirements of the customer is another USP as well. And another couple of aspects important are that to our large customers, the conduct of the partner like ours in a form and manner which is also catering to the sustainability agenda. If you recall the happenings over the last few years in the sector, the customer is very wary that is the counterparty fully compliant in terms of size, scale, stature. That's where PDS commitment to sustainability gives comfort to our customers as well. And then is the financial strength, given our balance sheet, given our size and scale, given our partner banks that we have, that is also able to give a lot of confidence to our customers. So I think, and also while these are, for example, an answer to a question if a business is beginning, in terms of strengths you pull together, but this has been happening over years. So therefore, a successful track record of conduct also gives immense confidence to our customer that PDS has been conducting itself in a form and manner which meets their requirement. That's answering the first part of your question. And the second one, it's interestingly, our competition is actually the sourcing teams of own customers, who also have a presence in the locations that, we have a presence. So therefore, our agility, our cost competitiveness, our proximity, as to how are we able to demonstrate to the customer that we can score well as compared to their own teams, is helping us win business. And I'm very pleased to inform you that from the current arrangement of doing this, we are engaged into a conversation with our customers for potential strategic partnerships, wherein customers are actually considering us, acting for a given sourcing location as their exclusive partner, that you please now deal with all the vendors with whom we have been dealing with. This is the direction in which our current engagement, with our customer is going. And as part of our sustainability agenda, besides the designers that I mentioned, besides the supply chain without the vendor partnership, we have invested into 41 senior professionals from the industry who have been pursuing this sustainability agenda. Recent one is Mr. Leslie, a Sri Lankan gentleman who used to earlier work for Walmart and CA Associate, who has come on board, to support our verticals in demonstrating to the customer that we understand sustainability and compliance. So I think these are some of our humble strengths which are enabling us win the business.
Got it. So there is no, like-to-like company which would be in the similar business which you can name?
No, I think, as I said, with a lot of humility, we have been pioneer of the way we have been operating. And as of now, in our sector that we operate, we haven't come across, I think what's also interesting is that for generating a $1 billion top line, which is what we are geared towards this year, one would have typically invested 400-500 million to assets to generate kind of 2 times the turnover and the assets, whereas the capital employed is far lower. So this unique model so far is we've been able to, implement it successfully.
And is there any change you are seeing in the overall business post-COVID in terms of, sourcing or supply chain, etc.? Is there any change you are witnessing?
So one is, of course, the newer category evolution. There is still a tendency of casual wear, smarter wear, functional wear. Then from the traditional categories, there's been migration to newer categories that has happened as well. And of course, the trend is a little bit towards faster fashion. Are you able to turn around as well? And I think other thing also is that, the customer is, because of the COVID restrictions, not able to travel all the way to the eastern world where the sourcing locations are. So to that extent, the partner with whom they are engaged for sourcing is a partner in close proximity to where the customer is located, is a partner using technology to a large extent, whereby they can not only represent, but also impart that experience to the customer, whereby the customer feels confident that while I'm not able to travel, the designing and the sampling and the final product selection, I'm able to seamlessly get it done through my vendor who's nearby to me. I think these are, important changes. And as I mentioned, one change that we see is evolving is the strategic sourcing, wherein, it's like retail sector has been under pressure, in the COVID time. So therefore, when there is pressure, you have to make strategic choices into what is core to your existence and business and what you can let go. So a B2C interface, your store experience, your visual merchandise, your assortment, your digital strategy, to cater through the e-commerce need is core to a retailer's business, whereas a back-end sourcing is important. But if there are credible companies, therefore, to answer your question conclusively, that direction is emerging. That can I consider letting go my sourcing to credible parties, who can meet my quality compliance standards and cater to my need.
Right. And sir, is it fair to assume that all the transactions would be back to back? When I say this, you don't carry any inventory risk on your books. All the inventory would be based on orders, right?
Yes, we don't, whatever we have inventory on our books is basis the order that we receive from the customer. Yes.
Got it. And just lastly, sir, on manufacturing side, if you can throw some light, how many locations do you have currently, and what kind of profitability you envisage maybe in one or 2 years down the line?
Actually, in terms of our own manufacturing, which is being done through the balance sheet of PDS, is 2 locations in Bangladesh. We have factories who are named as Green, which is for the top, and Progress Factory, which is for the bottom. And in kind of full scale operations, as we take them to not only full capacity but also full efficiency levels. I think somewhere 80 to 100 million US dollar. That's approximately 600 to 700 crore is the top line that we should be able to generate from our factories. As I said, capacity and efficiency utilization level. We achieved 225 crore. So if I just annualize, we are at 450 to 500 crore number. We would extract more to efficiencies. We should be able to generate close to about 35% gross margin levels from our factories, while our near-term target is getting a PBT break-even. But I think a 6 to 7% in 2-3 years from now, as we are able to extract maximum efficiency. So therefore, to summarize answer to your question, 80 to 100 million dollars of the maximum turnover that we will generate from our factories, 35% gross margin, and closer to 6 to 7% PBT to sales ratio.
Very clear, sir. And just lastly, what is the capex guidance for this year as well as next year, and how much will it go to manufacturing side?
So, as I mentioned in my opening remarks, we are relatively an asset-light company. In fact, in our first 6 months, our purchase of property, plant, equipment is close to about $1.5 million, about 10 crores or so in 6 months. And the last full year was $3.6 million, about 20 to 23 crores. We don't anticipate our capex to go beyond this 20 to 25 crore range per annum, because our motto is asset light, more partnerships, and that's first part answering your question. In terms of our own manufacturing investments, for the foreseeable future, we do not have any plans to further expand our own manufacturing. I think we have a job cut out to get the maximum throughput from our existing factories, and we are actively pursuing our strategic partnership agenda. So therefore, 20-25 crore per annum year over year is where we foresee. You can add $1 million more in terms of our investment in technology, but that's the maximum amount that we foresee at the current juncture investing every year.
Got it, sir. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Sameer Shah from ValueQuest. Please go ahead.
Yeah, hi, sir. Just one question. In terms of the visibility and the stickiness, if you can give some color on, what is the repeat purchaser, or, how your sales cycle moves, and how sticky is your relationships with your customers?
Well, relationship has been highly sticky. Some of the customer logos that we have been disclosing as part of our investor releases, these customers have been there, for last many years. If I have to just restrict my answers to last 5-7 years, then I would say top 2/3 top line has been coming in from relationships that have been continuing for many years, and I think it's going from strength to strength. We are adding newer relationships with large retailers in the US market. It is very tough to get in. They are large retailers. They have their own process, SOP, that one has to meet. So therefore, getting in is tough, and we are getting in there, which is visible through our numbers. And given our stickiness in the UK and European market, we aim to get the same stickiness, in the US market as well. So therefore, that's first part of answering your question in terms of, pretty much everything is stickiness continuing. We have been able to meet requirements of our customers. We're very vigilant, very careful of the credit risk that we take. So therefore, while there are opportunities, but we take a calibrated approach to not have a single large customer taking, a very large portion of our top line. We got to manage our credit risk well. That's how we kind of, on an average, if I take top 10 customers, they may not be more than on an average 6 to 7% of the top line of the company. That's on the stickiness and also on our own calibrated approach. I think in terms of cycle, well, as you know, typically it's a seasonal business. So as the season changes, 2 quarters in advance or 3 quarters in advance, you're engaged with the customers planning for that cycle. So that's very much, I think, going on. Like for example, if I have to talk about Q3, what we could achieve in Q2, we have similar order book well in hand for a Q3 as well. So I think therefore sickness from the past, quarterly behaviors, in line with industry seasonality, we are very comfortable with the relationships that we have been continuing with the customers. Of course, we have to be on our toes, be agile, cost competitive, compliance oriented, but it's a strong and healthy relationship built over the years.
So typically your customer also approves the manufacturer, or he trusts you and the billing happens through you, I presume. So you bill the customer and then you source it, which will be like a expense in your books. So does the customer also approve the manufacturing, or they just give you the guidelines and then you are free to source from anywhere?
Firstly, we largely act as a principal. We take goods on our books and then it is sold to the customer. So that's largely the way we operate. And it's a mix, in terms of customer approving. For example, our own manufacturing location, we have to get customer approval. The customer's local representative in the location or in the region come and visit the factory and provide a certification. That's typically how a factory is selected. So we also give representation in terms of how we have onboarded a factory. But there is 100% transparency being maintained with our customer. So if a customer wishes to visit a factory and wishes to visit that particular line from where the goods are being assembled, tailor put together, it's 100% visible. So it's a mix of the two to answer your question, and with 100% visibility to our customer and 100% open access to visit the partner factory.
All right. I'll come back in the queue. Thank you.
Thank you. The next question is from the line of Parth Desai from Horizon Capital. Please go ahead.
Hi. First of all, congratulations on a great set of numbers. So my first question was more around, just building on the momentum that you've gathered in the first half, because historically, if I see, the second half is actually much more stronger because of, the Christmas and whatever winter season, etc. So can we expect the same kind of momentum, like, the 25-30% year-on-year growth rate in the second half as well, or is there any guidance on that?
Well, it's a good question, a tough one for me to answer, but this is where we stand. We earlier had foreseen, and as part of our indication, we mentioned that we foresee a 12 to 15% growth rate for the entire year. I think in the beginning of the year, while the word was coming out of COVID, we all were very cautious. We continue to be cautious, but therefore the 12 to 15% aspiration was also having an element of caution built into it. So far, the growth has been 35% and in the first 6 months. And if I broadly recall, we did about 1,630 crores in Q3 and about 1,765 in Q4 last year. I think our order books are healthy, in terms of maintaining that momentum. It's on a higher base as compared to last year. But if I really have to speak about, very specifically, as I said, we did about 1,626 crore. You have to pardon me for trying to recollect the number of Q3 last year. And our Q2 sales, itself is about 2,195 crores. So as I said earlier in response to one of the questions, that our Q3 order book enable us see a similar kind of momentum that we achieved in Q2. To summarize, I think the risk to maintaining the momentum of 12-15% continues to be lower, and the order book continues to be strong, and the company is aspiring that it should continue to maintain the momentum in Q3, Q4 as well.
Excellent. And then, my second question was more around some of the trends that we are seeing in the sourcing industry. So, and I just wanted to confirm that. So, for example, moving from, a project by project sourcing to, something that's, an annual contract value. So, for example, your customers will tell you that, I don't want to deal on a project by project basis. You just source, 100 or whatever, 200 million worth of, women's stocks for me for the next fiscal year. Are you seeing any changes in the way that your customers are basically either changing contracts or structuring these contracts?
Every industry passes through its own evolution. So you tend to study, history. You tend to study the ecosystem around you and seek some inspiration, guidance. So I remind myself of what happened in the IT sector, wherein from a basic rudimentary need of connecting your phone to audio, video conference, to a networking, to actually, strategic sourcing, whereby third-party companies, reputed companies emerged, and you started outsourcing your entire IT network, even your server storage, your connectivity, everything to third-party vendors, because you felt there are credible parties who can cater to your end-to-end need. So I think, in my humble view, I see that trend emerging here as well, wherein the customer, from a project-by-project engagement to a strategic sourcing engagement. I in response to the first question about our USP, versus anybody else. So the USP that we have been developing, in a way, is allowing us to position ourselves before the customer as that credible party whom they can consider doing a strategic sourcing, that you please take the end-to-end responsibility of sourcing this and bringing to, either I do FOB or you take the responsibility. Well, largely we do FOB, but if you take the responsibility of bringing to my warehouse. So yes, to answer your question with that backdrop, with that context, I see things moving in that direction gradually.
Okay. And if I may just rephrase my question slightly, are you seeing the average contract value increase? Is that a trend that you are seeing as well?
Yes. The answer is yes. I think the COVID also led to consolidation on the front end in the retail sector, consolidation on the back end in terms of the other companies which have been manufacturing or supplying. Few companies do not exist on both front end and back end. As a result, the existing customers are doing more business, and the existing partner suppliers are also, getting to do more business as well. So that's one trend that has happened. And as I mentioned in response to your previous question and otherwise as well, that rather than thinly spreading across, many suppliers, price is not just the criteria. A responsible sourcing, in a compliant manner, on time, end-to-end representation of a, responsible value chain are increasingly the important criteria besides price and quality as well. So with that happening, rather than thinly spreading, customer is considering more credible, fewer partners, as compared to doing business with too many people.
Mm-hmm. Okay. That's good to hear. And best of luck, and thank you so much.
Thank you.
Thank you. Participants, if you have any questions, please enter star and 1. The next question is from the line of Nihal Jham from Edelweiss Securities. Please go ahead.
Yes, thank you so much, and good evening to the management. So 3 questions from my side. First is the expansion in North America mainly on the back of the manufacturing facility that we've created, and would it be possible just to give a sense of, who are these clients that we've onboarded?
Yeah, Nihal, what are the other 2 questions, please?
The second one was obviously from the perspective of when you see your performance, there has obviously been a significant turnaround that has happened over the last 4-5 years, both in terms of improvement in gross margin and obviously the scale has also helped see a significant improvement to the margins we used to make 3-4 years back. So if you could just specify or get into the specifics of what has driven both these aspects. And the last question was more from the industry side, that considering you obviously have a top-down view of how sourcing globally is moving, are you seeing any shift specifically happening out of China to into other geographies? And you've also focused on the Vietnam part in your presentation. So if you could highlight that.
Yes, I think on the first part, North America are inroads and increasing from 9% in 3 years to close to 15% is not just driven by our own manufacturing. Our own manufacturing has been a key, part of positioning ourselves to our customer, that we have our own manufacturing as well. And North America is more SOP-driven market, so therefore they really want to assess and understand that the partner they are onboarding understands what it takes to manufacture. So therefore, having our own manufacturing has been an important part of the position to our customer. But does that mean that catering to North America, is entirely coming in from our own factories? The answer is no. As I said, we have sold about $70 million, which is almost like 500 crores in the first 6 months, whereas our own factories are done 225 crores in the first 6 months in the entire top line. So to what we are selling to North America is more than double of our own manufacturing. And our manufacturing is not just America, to other markets as well. That's answering first part. But manufacturing capability and demonstration is very key, and I'm once again emphasizing that. And some of our relationship and retailer brands is Kohl's, is Morris's, is American Eagle, it's Fred Meyer, TKO, Walmart. These are relationships that we are continuously building, strengthening. That's the first part of your question. I think in terms of the margin trajectory, as one has been, pursuing in terms of larger share of wallet to a customer. But I think what is important is that henceforth, as we are adding in newer categories, whether it is home or accessories, they relatively give better margins as compared to apparel that we have been hitherto, training in. As we are working on, digital brands, which are, as I said, on, pre-sold basis in terms of inventory risk. As we are supporting our customers in taking their agenda ahead of having a private label, wherein they are choosing us as a partner to develop label for us, wherein they also allow us to also sell these brands to other retail chains as well. So I think these are some steps. And also as manufacturing, increases its size in the overall top line of the company. Currently, we have close to 225 crore out of 3821 crore in the first 6 months. But and typically manufacturing, in response to one of the question I said, is relatively 35% gross margin item. So as manufacturing, it's not of course going to be too large in our overall proportion, continue to be less than 10%, but in the near term, as manufacturing size increase as part of the overall top line. So these 3-4 factors, newer categories, digital brands, and also manufacturing slowly increasing the size in the overall pie, are some of the indicators as to how we take our, margin trajectory ahead. And of course, as we do strategic sourcing, there the margins could be relatively lower, but then there will be a huge throughput that is typically going to go through, our existing fixed costs. And these are all blue chip customers. So therefore, to the extent of being manager working capital will be efficient as well. So we are careful that if at all we are contracting more business, then there's larger volumes, but then it should be value accretive from an ROC perspective for our stakeholders. And on the third question that you asked, yes, I think one is witnessing that movement of business from China to other markets as well. And I think on the other side, Bangladesh continues to be a key market from the value fashion side. India has government has announced important attractive measures. Vietnam is also an important market, as I said. So therefore, yes, to answer specifically your question, one is seeing that the neighboring other geographies benefiting from that moment.
That is very helpful, Sanjay. I wish you all the best. My question.
Thank you.
Thank you. The next question is from the line of Sandeep Agarwal. Please go ahead.
Yeah, hi, good evening, and congratulations on excellent execution, Sanjay and team. So Sanjay, I have a couple of questions. what is your sense how this industry has been impacted by the COVID wave? Because when we see, when we speak to the largest retailers globally for our IT services channel check and other things, what we gather from them is that, most of the large retailers are now seriously considering or already has considered to outsource their procurement department because they firmly believe that, 4 to 5% of cost, if it goes in procurement, it gives them a lot of management bandwidth to focus on the core business because their management bandwidth is right now more prioritized or required on, making their front end ready to compete with the online players the Amazons and others. So management and their team wants to focus more on concentrating to gain market share and retain market share, and they really don't want to focus too much on the procurement side. That is one feedback which we have been getting in last 12 to 18 months from different large brands. So I just wanted to reconfirm with you whether this is a trend which you are witnessing, and if yes, then who will be the biggest beneficiary in that? So that is one question, and I have another question which is again, linked and based on our continuous discussion with global brands is that most of the brands also suggest that this is just the beginning, and it looks like to them that it can really become a much bigger wave where this procurement itself will be looked as an external function versus the internal function because of the country from where it could be done at a cheaper or affordable cost, and the compliances and other things, complications which come into picture because of those geographies, and they really want a stable platform or a stable mediator who can execute it for them. So that is question number 2. I have one more, but I will come back in case.
Yeah, I think the feedback, Sandeep, firstly, before I respond to your question, thank you for the compliments on the results. I think we'll continue to strive to, keep delivering a good performance to our stakeholders. And the feedback, to answer your point, that you have been getting is the right feedback. And I also mentioned in response to a couple of questions earlier that one is seeing the trend wherein the customer is focusing, if at all, COVID and has resulted into customers choosing to focus more on the front end interface with the customers, choosing to channelize energy alongside the physical stores into digital stores as well, and therefore they want the back end part of it or the sourcing part of it not to be sitting in their own balance sheet. Yes, that has started to emerge into our interface with some of our customers, and I see this trend getting converted into tangible business opportunities in the near term. It's a serious possibility, and I think who's going to win, to answer your part. I think the credibility of the counterparty to whom the customer is letting go the sourcing, internal sourcing. The credibility is a simple word, but it has many connotations. Credibility in terms of financial credibility. Is the partner having a decent size, scale, or balance sheet? The governance part of it. Is the partner run in a on the pillars of strong governance, compliance, sustainability and compliance. Are the factories from whom my partner is sourcing, whether through own manufacturing or the partnership, is my partner able to not only represent to me? Representation is one thing. What are the processes, systems, internal strengths that my partners have invested into? That's what I mentioned about 41 people in our own internal compliance team, who are there. So therefore, in terms of governance structure, in terms of financial stability, in terms of compliance, and the global reach, and the fact that is my vendor not only having a front end close proximity to where I am, at the same time also have a strong presence to that part of the world from which is sourced. And it is not just a rep office. Do they have the right kind of people on ground, in Bangladesh, in other parts of the world where manufacturing is done. So these are some important, criteria that is being chosen. That is part of the dialogue, part of the engagement that is on, with the customers, as this feedback that you got as an emerging trend, hopefully is, going to soon get converted into some tangible business.
And one last question, which I'm again, getting from our discussions is that, because of the COVID, many brands which were very concentrated into particular parts of the world are concentrated into few geographies and were not accessible by some of the countries like India or Africa and some other nations where people were not able to find those brands and buy those brands. Because of the COVID and the digital wave which is coming and the smart stores and digital stores which have replaced the physical stores, they are seeing that basically world has become a store for them because of this online mode. And if that is true, then there are two things to it. One, obviously, it re-emphasizes their focus to be online on the digital store, and management bandwidth needs to be reallocated there. And secondly, it also implies that the brands which were not able to sell in those parts of the world earlier now can sell in every part of the world, which also implies that the sales of these global brands can now get a booster shot because of this change in business dynamics. And if that holds true, then obviously, the procurement and other aspects of the businesses may actually go out as a support function and can witness a very strong wave of being outsourced. The only challenge which I am not able to figure out in this whole story is that will it be a volume game or it will be a value game for players like you and yourself? So if you can help me on that one will be great. And thanks and congrats once again on a good quarter and best of luck for next quarter as well.
Thank you, Sandeep. I think, yes, once again, the feedback that you've been getting or observation that you're getting that for certain brands, the entire globe is a market, piggybacking on the e-commerce channels. Yes, that is very clear. And to that extent, what it also implies is that when a brand is thinking of globe as a market, does the brand has, vendor partners who also have a global supply chain network in place, through their partner factories, through their partner logistics network, and that, PDS has been building its strength into the direction. To that extent, if what you observe as an emerging trend, we are very much prepared to convert that trend into a business opportunity for us. That's where I mentioned in my opening remarks that we continue to, besides Vietnam, Sri Lanka, Bangladesh, India, and China, we continue to lay equal emphasis on Turkey as well as a location, because when we come to e-commerce digital channel, it moves fast. And therefore, Turkey as a location in the central part of the world allows me to meet the quicker turnaround time requirements of our customer. Therefore, in my opening remarks, Turkey as a key strategic location, enhancing a presence is very important part of it. Now, answering your second question in terms of whether it will be a value, trajectory or a margin trajectory, I would say, typically when you have, high volume, it on a historical observation basis across industries, it comes at, relatively, well negotiated prices. So on a standalone basis, one could feel that it could be a low margin item. But I think what is important is that how that gross margin is, you are able to transform or translate that into your EBITDA margin. Are you contracting OPEX in line with your growth? I think for such large opportunities, one should be able to translate, the lower gross margin to a better EBITDA margin by operating leverage that is going to come alongside the business. And as PDS carefully is evaluating, taking this path ahead, PDS is also channelizing its resources and energy into newer categories, which are augmentative in terms of margin. And PDS is also, channelizing to digital brands, we should be again augmentative. So I think it's a blended approach, going forward. But what is important are two performance metrics which are important to our internal decision making. One is operating margins, as we move ahead. When I say operating means EBIT margins, and secondly, how much capital, how efficiently am I able to use my capital to generate or the EBIT margins. So that's about ROC. So I think these are the two important yardsticks which are going to be key as we contract into new emerging opportunities.
Thank you. We have the last question from the line of Chirag Lodaya from ValueQuest. Please go ahead.
Yeah, sir, if you can just help us one basic thing. How would transaction take place in sourcing business, say from a retailer to PDS to vendor, and again final goods are again sent to a brand? If you can simplify this, it will help us.
Yeah, so let's start from the customer. So let's start from leading retailers in London. So I have my on-ground engagement team present in London, and who engage with the customers in terms of engagement, in terms of sitting together, visualizing what is going to be the expected trends, what is the category, emergence that is going to happen. So therefore, customer feels there is somebody who is thinking alongside me. That is step number one. And when that engagement is leading to some kind of tangible visualizations, I have my designer team sitting next to the engagement team in London, and they start engaging, with my engagement team, and engagement team is able to take the designs to the customer, and then we are able to convert those design into samples. And the usage of technology is allowing me to convert into digital sampling and imparting almost like an in-person experience. That is the second part of it, and that sampling is then leading to a decision to be done by the customer in terms of, yes, this is what I like, and then the customer engages into, okay, this is for my spring season beginning next year. So what is the lead time from how are you going to what is the lead time you need? Then I am able to give an indication, because the moment I have a design selection, the same set of my team, which is the front end team, have also got a corresponding sourcing team in Bangladesh and Sri Lanka. So they're able to, at the back end, engage into a dialogue with my sourcing team. So therefore, having selected a design and the customer is asking me, what is the lead time? When are you able to get the goods? X works or FOB basis in Bangladesh as a location. I have my ongoing team in Bangladesh, Dhaka, who is engaged with my partner factories and is able to give an answer. That is where the contract gets signed off. Of course, the financial controller, the CFO, who is also based for that sourcing team in London, also is sitting next door. Design engagement team, design team, as well as the CFO team is sitting there. It's only the sourcing team, which is actually sourcing from the factories, who are sitting in Bangladesh, Sri Lanka, or other locations. And that's how the contract is stitched up. And if at all there's a standard template we have for contracting, any deviations, then they come to a central team if there's in terms and conditions, etc. And then contract is then passed on to the relevant sourcing team, just say Dhaka as an example. And there I have a quality team, I have a quality inspection team, I have a planning team who is there sitting now in Dhaka, who now in turn, work with the factory. If case there is a nominated fabric and trim supplier, by the customer, then that is how the contract is executed. Otherwise, I have a sourcing team which comes into an action. I have a Hong Kong headquarter global sourcing head who channelizes the pricing benefits. Sorry, it's a long answer to your short question, but that's how typically the cycle works. That on-ground team now visits the factory, carries out the inspection, clears the good, invites the customer representative that the goods are ready for inspection. The inspection is done, and then the FOB shipment is executed. And that's how the cycle goes.
So basically, finished goods from vendor is directly shipped to a brand owner or a retailer. You don't need to keep any inventory with you. So it's a direct transfer, right? I mean, you don't have any warehouse as such to carry or hold the inventory.
I think to give you a very clear answer, if we have done $540 million top line I would say 85-90% is FOB in the manner you are saying. Is the last 10-15% which is duty paid delivered or our responsibility to bring the goods to the warehouse of the customer. That's largely our business is the way you just summarize in the end.
Right. And you don't take any currency risk or, inventory risk, etc. Or everything is back to back, right? And it's covered.
Yes. We don't keep inventory. If we have order, that is how it leads to recontracting inventory. And yes, there is natural hedge to a large extent, but wherever there is a cross currency involvement, especially on the OPEX side, for example, in UK we bill in US dollar, whereas my expenses are in GBP. I have an active internal treasury team which keeps an eye on it and manage the FX risk effectively.
And is there a scope to improve margin substantially from here with the scale going up, or this is the band, you are happy, maintaining this?
I think I responded to it earlier as well, that 2-3 factors. One is on as is where is basis. In the industry we operate, there is always the ask to keep improving prices. So how agile and flexible are we to introduce new streams that leads to better margins, which I touched upon as categories, brands. That's one thing. Then manufacturing, including, and to an extent, if there are large strategic sourcing deals, that's what Sandeep was asking and also asked earlier as well. Then how are one able to derive the fixed cost operating leverage and able to translate this to better EBITDA margin. So these are some of the 3-4 factors which will continue to be relevant in terms of the evolution of margin trajectory going forward.
Okay. Thank you and all the best.
Thank you.
Thank you. That was the last question. I now hand the conference over to management for closing comments.
Thank you so much, ladies and gentlemen, for participating in our conference. Thank you so much, Edelweiss team, to organize it. And we wish you all the best. All of you stay safe and take care. Thank you so much.
Thank you very much. On behalf of Edelweiss Securities Limited, we conclude this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you. Thank you all.